Is Bitcoin overvalued? That's one of the most common questions that I get from people who are considering jumping into the markets right now. Fears of missing the boat abound, and no one wants to buy the top. Indeed, we're now sitting near all-time highs, and there are many who think that a correction is due. So, are their concerns justified? Well, that's exactly what I'm going to look into today. I'm going to break down numerous scientific Bitcoin valuation models and try to assess whether its price is fair. No moonboy hopium here, just pure data and analysis. That's all to give you the information you require to decide whether now is still a good time to buy. So, miss this at your peril. Before we get cracking, gotta do a bit of yapping. If you came to this channel in search of financial advice, I'm sorry to disappoint, you won't be finding that here. If you came here for educational and entertainment purposes, then you're in the right place. Now, with that out of the way, I would like to welcome all of the new viewers here today. My name is Guy, and I'm your guy for everything crypto. From market news to coin reviews and protocol overviews, it's all on my menu and ready to serve up to you. If you want to make sure that you're first in line when a new video leaves the kitchen, then I highly suggest that you hit up that subscribe button. You'll also want to turn on all those notifications to make sure you aren't missing any of this content. Sometimes it gets lost in cyberspace. Final thing, here are some timestamps in the video timeline. They're there for your convenience, so do feel free to skip around if you're strapped for time, although you are best served watching this one the whole way through. Alrighty, ready, set, crypto. So, how does one go about valuing something like Bitcoin? I mean, it doesn't fit into most of the financial models that we tend to use in traditional finance. When you're looking at stocks or bonds, these are usually considered to have value because they either give you a stream of income or they give you ownership of an asset that generates income. In the case of Bitcoin, there are no income streams. It generates no revenue and hence cannot be valued currently using any sort of discounted cash flow valuation. Moreover, unlike raw commodities, there's no end use case for Bitcoin. Oil is used for power. Gold can be used for jewelry. Soybeans are consumed. All of these assets have a use case that gives them value right now. So it's hard to value it based on global macro trends that tend to drive demand for traditional commodities. Bitcoin is valuable because of its inherent qualities as a store of value. It's limited in supply and it is immutable. It's easy to store and move. It's cryptographically secure and impossible to replicate. But being able to place a value on any of these factors is not so straightforward. Indeed, this is perhaps why some no-coiners struggle to wrap their heads around Bitcoin's current price levels. So, when it comes to valuing Bitcoin, we have to use bespoke models that take into account historical prices, on-chain data, network effects, scarcity, supply and demand. Some of these valuation models incorporate a number of these factors in order to come to the best estimate of the fundamental price of Bitcoin. I'm going to break down each and every one of these valuation models and explain how they work. And by the end, I hope that we can come to the best conclusion as to whether Bitcoin is fairly priced. Let's start with perhaps one of the most well-known and lauded valuation models currently out there. That is the stock-to-flow model. This was developed by a pseudonymous analyst who goes by the name Plan B on Twitter. The reason that this valuation model has been so popular is because of its sheer accuracy. We're currently sitting at levels that have been predicted by the S/F ratio. While there are periods of diversion away from the predicted price, like a celestial magnet, it tends to bring the price back in line. So, how does this model work? Well, it's essentially a measure of the supply of a particular resource relative to the rate of supply growth. It's a ratio of the outstanding stock to the flow of that resource. This model has previously been used to value other scarce resources such as precious metals, gold, silver, etc. Using the example of gold, current estimates of its supply are about 197,000 tons, and every year you have about 2,500 to 3,500 being mined. So, if we were to take the ratio of the two, that leaves us with an S/F value of 65. It takes 65 years of gold production for us to get to the current stock of gold. This is what gives gold that scarcity component. When it comes to Bitcoin, the currently outstanding supply, stock, is about 18.6 million BTC. A new block is mined about every 10 minutes, and the block reward is 6.25 Bitcoin. So, if we extrapolate that out, it means that in a year we're mining about 328.5k BTC per year. That would mean that Bitcoin's current S2F ratio is 56. It's also important to point out that the S2F for Bitcoin is always going to be increasing. Why is that? Well, when we go through halving events, the block rewards fall by half, which means that the denominator falls. By the time that we reach the next halving, in about 3 years, the S2F will increase once more. After that halving, the S2F is likely to be above gold, as gold supply has always been on the increase. Let's not forget that jewellery demand. Okay, so you know what the model means, but what does it tell us about the price of Bitcoin? Well, Plan B has developed a linear regression model that maps the market value of Bitcoin with its stock-to-flow ratio. He found a really strong statistical relationship here and has extrapolated it out into the future. Using the model, here you have what the theoretical price of Bitcoin should be based on the S2F. And here we have the actual price of Bitcoin overlaid on top of it. As you can see, it's been tracking it pretty damn well. In fact, if the S2F ratio is to be believed, we could be seeing a Bitcoin price of 100k by as early as May. Bonkers. Now, having said all of this, there are times in the past where the price has actually deflected from that which has been predicted by the model. This is what is termed the S2F deflection. You can look at that chart over here on Glassnode. As you can see, there have been times in the past where it has deflected quite far away from the model price, usually to the upside. However, as time has progressed, we see that the deflection has become way less pronounced. The model has become that much more accurate. In fact, at the time of this video, the deflection ratio was close to 1, which means it's almost bang on the sats. So, based on the stock-to-flow model, at least Bitcoin is fairly valued. I should of course point out that this is based on modelling past prices, and as we know, past performance cannot be a predictor of future returns. But it's got a good track record so far. Another really useful metric that you may want to consider is something called realized capitalization. Quite simply, it's a measure of the aggregate cost basis of all the Bitcoin that has ever been moved. It's calculated by taking the price of each Bitcoin at its last on-chain movement. Those coins that last moved back in 2012 will have much less of an impact on the market cap than those that moved yesterday. The goal of this metric is to try and de-emphasize the impact that these older coins will have on the market cap. This is because a reasonable proportion of the coins that last moved back in 2012 are lost coins. Lost coins are those where the keys were lost or the coins are otherwise inaccessible. So, it's a more accurate measure of the true market value of Bitcoin. Over here, we have the realized market cap of Bitcoin. It's currently sitting at $298 billion. So, based on Bitcoin's current circulating supply, that implies that each coin should theoretically be worth $16,000. Based on this metric, therefore, it could mean that Bitcoin is overvalued. The dead coins that have never moved are being overvalued compared to those that have moved more recently. You can actually compare the market price of Bitcoin to this realized cap measure by looking at the MVRV ratio. As you can tell, the ratio is pretty high now as the market cap is much larger than that model according to the realized cap. Okay, so this metric tells us that Bitcoin is overvalued by a factor of almost 4 times. However, you have to ask yourself how relevant you think this really is. What the model is telling us is that those coins that are lost should not be considered to have as much value. This is indeed true if you were to view Bitcoin's value through the lens of network value. Coins that cannot be moved cannot be spent, and hence add no additional value. However, I would counter that those coins that are lost reduce the stock of Bitcoin on the market. They are coins that can't ever be sold, and hence make Bitcoin a scarcer asset than we think. So, that's an important point to consider. When it comes to valuing stocks on Wall Street, many financial analysts use what is termed comparable analysis. Basically, they try to value specific companies based on financial ratios that other companies have in the market. For example, We're talking ratios like price to sales, price to book, etc. These are the fundamental valuation factors that get Buffett hot under the collar. Now, when it comes to Bitcoin, it's pretty hard to find digital asset comparables. However, what you can do is try and analyze it based on how other store of value assets are priced. I want to draw your attention to this investor note that was written up by Paul Tudor Jones back in May of last year. For those that don't know, he's perhaps one of the most well-known global macro investors around. In this specific note, he ran a comparative analysis between a range of assets as it related to their benefits as a store of value. He used 4 characteristics in order to assess this: purchasing power, trustworthiness, liquidity, and portability. Then he scored financial assets, fiat, gold, and Bitcoin according to those criteria. This was all put into his composite model to arrive at these scores which indicate their ability to hold value. Because this is quite arbitrary, I've also taken a look at this report from Grayscale that has tried to break it down a bit more concretely based on those 4 factors I just mentioned. Now, I will frankly admit that I don't agree with the ratings that are given to the likes of financial assets or cash. However, what's interesting to note here is the score. He gives gold a ranking of 62, whereas he gives Bitcoin a ranking of 43. So, gold's score is about 44% higher than Bitcoin's. However, at the time of this video, gold's market cap is $11 trillion, almost 11 times greater than Bitcoin's. Or how about we look at Bitcoin versus fiat? Fiat has a score of 71, which is about 65% greater than Bitcoin's. However, fiat currency has a total dollar value of $266 trillion, 266 times that of Bitcoin's market cap. So, what does all this tell us? Well, on a relative basis, Bitcoin is extremely undervalued. Even if you do believe some of the questionable assumptions in Paul Tudor Jones's model here. This relative value point was actually a point that he specifically noted in the report. Indeed, it seems as if Bitcoin took center stage in that report, as Paul talked about it quite extensively. It was also in this investment note that Paul disclosed that he had bought Bitcoin. Well, I'm sure he's sitting pretty happily with that investment right now. While trying to determine the exact dollar value of Bitcoin can be tough, you can always try and estimate whether it is over or undervalued based on how other market participants are reading it. If whales and miners are likely to sell at certain levels, this implies that they perceive those levels to be overvalued and vice versa. Hence, it often helps to try and read market sentiment from on-chain statistics. Market sentiment of whales and long-term hodlers are important. This is because these participants are more likely to have a reasonably correct view as to the price of Bitcoin. They tend to sell at levels that they perceive to be overvalued and hodl at those that are undervalued. This is in contrast to smaller wallets that have held for a shorter period of time. They are more likely to be new entrants who cannot read the market as well. When it comes to the hodlers, there are a few metrics that I like to use. One of them is the spent output age band. This is a metric that the folks over at Glassnode have pulled together. What it shows is the percentage of all spent output that was created within a particular age band. Each of the lines over here represents the percentage of spent outputs that were created in the time bands highlighted. In this case, I've chosen to isolate all those transaction outputs that were spent in a period of shorter than 3 months. As you can see, this is over 95% of all spent output. Put it another way, only 5% of all the spent output came from coins that were older than 3 months. So, what does all that mumbo-jumbo mean? Well, if we were to categorize all those users with spent output of fewer than 3 months as short-term holders, and those with outputs greater than that as long-term holders, it shows that only the short-term holders are moving coins right now. The long-term holders are hodling their coins, which means that they have a more favorable view of Bitcoin's value right now. However, if you start to see that some of these older coins are being sent, it could be an indication that hodlers are looking to take profit, perhaps moving them onto exchanges. Another hodl metric that you guys may like from Glassnode is what they have aptly named their hodl waves. These basically represent the proportion of certain supply that's held by UTXOs with different lifespans. In other words, it measures coin supply that was last moved a certain time period ago. For example, A hodl wave of the 10 years plus means the percentage of coin supply that has not moved in 10 years or more. The hodl wave of 24 hours is all those coins that were moved within 24 hours since they were last moved. You still with me? Feel free, by the way, to fire any questions into the comments and I will try to get back to you. You'll also find links to all the resources I'm using here. So, by taking a look at these hodl waves, we can get a sense of what supply is being moved, whether the long-term supply is being transferred to the short-term supply. This could imply that the longer-term hodlers are selling to the newbies and could hence indicate that they perceive current levels to be overvalued. Here we have the hodl waves for all supply that's less than 6 months old. As you can see, there has been an uptrend recently. Older supply is being sold for those newer to the market. However, what you should note is that the percentage of newer supply in this bull run is much lower than it was in the previous bull run. What this means is that a larger proportion of long-term hodlers are holding during this bull run than they were back in the previous bull run. Again, a sign of their perceived value of Bitcoin at these levels. When it comes to reading the whale movements, it's a lot more simple. One of the most reliable indicators out there is just to examine the number of wallets that have more than 1,000 Bitcoin in them. Here we have the number of whale addresses over at Glassnode. As you can see, ever since June of last year, the number of these addresses has been on a steady rise. We went from 1,800 addresses to a peak of over 2,200 in February of this year. This shows that whales are indeed hodling these coins and stacking into the bull run, an indication of value from these large buyers. Given the recent institutional frenzy we've seen, these wallets could easily be linked to a few of them. Of course, we have seen a small decline in the number of these addresses since mid-February. Either these are an indication that whales are selling their coins, or it could be that they're moving them into custody solutions. I happen to think that it's the latter, merely because we're also seeing a fall in exchange balances. So, these whales are certainly not moving their coins to sell them. They're taking the next step from cold storage to deep freezing those sats in some hardcore custody solution. I would too if I held more than 1,000 Bitcoin. So, we've covered long-term hodlers and whales, but there is one more market participant that cares less about value and more about income. That is because selling Bitcoin is central to their business model. I am, of course, talking about the miners. Although this piece is on assessing Bitcoin's value, it's also important to analyze the impact on the markets from miner sales. This is particularly relevant now, given the fact that large-scale miner outflows were blamed for Bitcoin's dump a month ago. Two of the metrics that I like to look at the most are the miner outflow and the pool multiple. The miner outflow is a ratio of the Bitcoin flowing out of miners' addresses relative to the 365-day moving average. When this ratio spikes, it indicates periods when flows out of these miner addresses are higher than normal. What this therefore tells us is that when this ratio spikes, these particular levels are where miners are looking to most likely liquidate a lot of their coins. You can see the ratio over here and how it has evolved over the past 3 months. Do note these periods over here where it has spiked. If you'll recall, Bitcoin initially fell from its all-time high here when it was revealed that the F2 pool was dumping its holdings. Right now, it appears as if the ratio is low and approaching 1. This indicates that miners are hodling their coins more, a bullish sign. Of course, the miner outflow multiple cannot really be seen as a forward-looking metric. This is because you'll only know that the coins have moved once they've hit the blockchain. This is where the pool multiple comes in. It's a pretty simplistic yet amazingly accurate predictor of miner selling points. It's basically the ratio of the total dollar value of coins that are being issued on a daily basis divided by the 365-day moving average of the metric. It's a measure of the value of coins that are entering the ecosystem on a daily basis relative to the historical norm. Miners tend to sell when they're earning more than usual and hodl when they're earning less than usual. The pool multiple is broken into bounds, and when it's above 3, it means miners are likely to sell. When it's below 0.5, they are more likely to hodl. Currently, we are still in the median range, but I would watch how this evolves over the next few weeks. So, those are some of the metrics that I use to determine the movements of those forced sellers. That's it for most of the video, folks. A few closing thoughts now from moi. Bitcoin is very hard to value. It doesn't fit too well into the financial models that traditional CeFi folk tend to use. This is perhaps why it's so mystifying and why its price action baffles so many people. However, as I've shown in this video, there are a number of models and metrics that can be used to get a sense of whether it is over or undervalued. I must admit that I have become quite a convert of the stock-to-flow model. The reasoning for its inputs makes complete sense. Moreover, the model has been pretty damn accurate over the past year, and, if it's to be believed, we could be seeing that 100k level pretty soon. We can then also take a look at whale movements and what the longer-term hodlers are doing. They are more knowledgeable about the market, and if they're stacking sats, you know they perceive it to have value. While miners may sell in the short term, they have exhausted a lot of the supply that they had last month. This therefore means that even though they're earning more now than they did historically, when they sell, the price impact is likely to be less pronounced than it was a month ago. Finally, the fact that legendary investor Paul Tudor-Jones has decided to pick up Bitcoin is a massive show of confidence in my book. I'll also add that since that time, he's been joined by a slew of well-known investors who have joined the Bitcoin revolution. Perhaps they read his report. Speaking of which, I want to leave you with this quote from Jones in it. Quote, "At the end of the day, the best profit-maximizing strategy is to own the fastest horse. If I'm forced to forecast, my bet is it will be Bitcoin." So, what horse are you betting on? Whew, that was a long one, so well done for sticking around, folks. Now is the time that I ask for your much-needed input. I would love to hear what you folks thought of that video. And are there any other metrics that you like to use? And how soon do you think we could be seeing a 100k Bitcoin? Please do let me know in the comments. And while you're down there, you just have to check out my socials page. This includes links to the following: my Insider Telegram channel for daily market analysis and coin tips, Twitter for my thoughts on the latest news and reviews, Instagram and TikTok for some behind-the-scenes views here at the Bureau, and finally, the creme de la creme, my weekly email newsletter. This is my once-weekly take on the crypto markets where I share everything you need to know, including the breakdown of my personal portfolio. All of which you shall seek is linked to below. And finally, I assume that because you made it this far, you got some value from it? Well, be sure to give that like button a visit and hit that subscribe on your way out. My next video is cooking in the kitchen. Ooh, and it smells pretty damn good.